Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. Thanks for joining me today. So why shouldn't I just invest in the S&P 500? That's a question we're going to talk over today briefly. So when investing, many people turn to the S&P 500 for its historical performance, its reputation as kind of a cornerstone of the U.S. stock market. The S&P 500 tracks the 500 largest publicly traded companies in the U.S. But is it the best or the only option for investors? I mean, it is the most prominent index in U.S. markets. It's prominently highlighted in the media, always talked about in the news. And so it's no wonder that it lives in the spotlight in most people's minds. They think of the S&P 500 when they think of the stock market. So it can be a great foundation for a portfolio. It has its place, but investing solely in this one segment of the market may not always be the best approach. So we're going to explore several reasons why relying solely on the S&P 500 might not be the ideal strategy for everyone. So first off, let's talk about limited exposure to global markets. So the S&P 500 only tracks US-based companies. So while many of these firms are multinational and they get revenue from global markets, the index still primarily reflects the US economy. And so if you invest exclusively in the S&P 500, it means you're missing out on opportunities in international markets where growth prospects might be different. So one famous example of this is the lost decade. It's kind of a phrase used to describe the period from the end of 1999 to the end of 2009 when the S&P 500 had a negative return. So while the S&P 500 was negative during this time period, other indexes were positive. For example, during the same time period, global equities, small caps, and emerging markets all outperformed the S&P 500. And there is a graph on the blog post version of this episode. You're welcome to check out. It kind of shows an illustration of things like the Vanguard Global Equity Fund, the Dimensional Emerging Markets Fund, Dimensional U.S. Small Cap Fund against the S&P 500. And by the way, disclaimer, none of the funds or securities that I mentioned in this podcast should be taken as an endorsement or recommendation, simply examples. So this is not the only period to consider, and you can certainly find many periods when the S&P 500 outperformed other indexes. But the point is that diversification helps you keep your exposure spread across many different markets, which can reduce your risk overall. So we tend to have home country bias in the U.S., and that can lead us to thinking that domestic stocks will always outperform. We think that, oh, well, we're in the U.S., we're biased toward our own country. That's natural. But history shows that there have been many time periods when international markets have outperformed. Again, another graph in the blog post if you want to check it out. There's periods in the 70s, periods in the 80s, periods in the 2000s where you can see international markets did outperform the US. And these things have historically shown to be cyclical. Now, again, we can't predict the future, but if history is any indication, that's an example of what has happened in the past. So diversifying beyond the S&P 500 can really help us take advantage of international markets during these periods of outperformance if they occur. All right, another factor, sector concentration risk. The S&P 500 is not as diverse as many people might think. It covers 11 sectors of the economy, and it's heavily weighted towards certain industries, especially technology. So recently, some of the tech giants like Apple, Microsoft, Google, these all dominate the index, and this can end up creating sector-specific risk. So while tech stocks are, sometimes really doing great, they're very prominent, that helps the S&P outperform. But if the tech industry has challenges, the entire index could suffer. So diversifying into other asset classes or sectors that are underrepresented in the S&P 500, like small caps, real estate, even bonds, alternative asset classes, that can help protect your investments from these types of sector-specific downturns and risks. So again, on the graph, if you want to check it out, on the blog post version of this, there's a breakdown showing the sector allocation in the S&P 500 that showcases the tech-heavy nature of the index. And in the graph, you'll see that over 32% of the index is made up of technology. The next closest sector is financial services, which is around 13%, and the others are a bit further behind even than that. So tech makes up a massive part of the index, about a third of it at this point. So if you're over relying on the S&P 500, you're over relying on just a handful of companies and sectors, and broad diversification into other investments can help you mitigate that risk and reduce the risk. All right. Also, volatility and downturns. So while the S&P 500 has generated pretty good long-term returns, it's not without its volatility also. So over the last 20 years, the index has experienced pretty significant drawdowns during market corrections. Most notable was '08, the financial crisis, when the S&P lost around 50% of its value. And if you have lower risk tolerance or you're approaching retirement, the S&P 500 could lead to pretty uncomfortable drawdowns and swings. So over time, that volatility can cause issues both emotionally and mathematically. So it can be stressful emotionally to see big swings in your investments. At the same time, it can also make it difficult to recover from drawdowns, which can affect your overall total return. There's a pretty good chart from BlackRock that is, again, in this blog post version. So go check that out if you want to. And it shows multiple segments, different kind of time periods from 2000 up to 2022. And basically, it's kind of interesting. It shows a little commentary on the side of each segment. And pretty much all of them say things like, oh, I lost money. Oh, I didn't make as much. Oh, I lost money. Didn't make as much, because it compares that segment's return against the S&P 500. Sometimes it does say, oh, diversification works. There's a couple periods where there's a little bit of a happy face there, but overall, it's kind of like showing disappointment in each segment. But then at the end, overall, it shows that your total growth is higher using a diversified portfolio as compared to the S&P 500. And so when you zoom out to see the big picture, the microcosm of individual short-term performance against the S&P might tell a different story than zooming out and seeing the big picture. So there's an adage, there's kind of a saying, diversification means always having to say you're sorry. It's a common way to describe the reality that a diversified portfolio will always have some underperforming assets. And that's really because diversification involves owning investments across multiple asset classes. And it's almost impossible to predict which asset class will perform best in a given year. So that's why we diversify, because we want to have that broad exposure to different asset classes, markets, and sectors, so that we don't always have to have one segment tying up all of our investment returns. All right. So another factor is tailoring your investment goals and your risk tolerance. So one of the most important reasons not to exclusively invest in the S&P 500 is that it might not align with your personal financial goals. Every investor has different risk tolerance, time horizon, financial objectives. While the S&P 500 might be a good fit for a growth-oriented investor, maybe younger, long time horizon, might not be appropriate for someone who needs more conservative investments, or perhaps someone has an angle toward ESG or sustainability or socially responsible investing. The S&P 500 is not geared toward that. So if you want to tailor a portfolio to your preferences, you want to have a more diversified portfolio. All right. So overall, nothing wrong with the S&P 500. It's a strong investment choice. It's an index that has historically done pretty darn well. Nothing wrong with it, but a well-diversified portfolio typically includes a mix of domestic, international, real estate, sometimes other asset classes, even alternatives, sometimes fixed income. And that's likely to provide more stability and protection against a broader spectrum of risk areas. And so instead of asking, why shouldn't I just invest in the S&P 500, maybe consider reframing the question. How can I build a diversified portfolio that aligns with my goals? The S&P 500 just gets a lot of attention because the media has trained us to pay attention to it. The media has trained us to focus on it. But if you incorporate that into a broader strategy, you've got potential for growth while also managing the risks associated with things like market downturns, sector concentration, and other factors. So again, nothing wrong with it, but it's not the end all be all for everyone. And diversification has a place and can have value. So, all right, with that, as always, feel free to reach out. My website is elevationfinancial.com, and you can find me there. You can send a message through my website. You can book a free consultation to learn more about working with me. You can hit me up on social media. Pretty easy to find. So with that, thanks for joining me today. Have a great day. We will see you next time.